Good afternoon, everyone. It is January 30th of 2023. This will be the last weekly update for the month of January. And the good news is we're definitely having a better start to the year than last year. Certainly doesn't take all that much for improvement when we think of how rough the start was, how rough of a start it was to last year. But you know what? Progress is made in steps. It's not made in leaps and bounds. And I think the big narrative for the month of January is that we've made significant progress, but without taking that speculative technology risk that has actually really pushed to another level here in the month of January. So over the last 2 weeks, we've seen some money short cover and rush in to some of those more speculative corners of the market. We think that's actually a great time right now to unload some of that inventory and shift it into what we call the new leadership areas of the market. Now, again, the good news is we've realized pretty significant gains without taking that speculative risk. So we're happy with that. So let's go ahead and get started. As we do every single week, I'm going to go ahead and share my slide. And really what we're calling this week's presentation is, making money in the new market. How can we do that? And one thing that we've been talking about quite a bit for the last couple of months is that, bear markets are not here to try and lose people money. Unfortunately, part of one of the symptoms of a bear market are that people's accounts go down in value, whether that's in line with the market or if you're on the growth side or the value side, depending on what type of bear market it is, it can go down more than the market. And certainly we saw that with growth stocks last year. But the real objective of a bear market is a mechanism for change. It's a mechanism for regime change and ushering in new leadership while taking the old leadership and ushering it out the door. And so this week, we're going to go through three key things. We're going to review the demise of that established regime that dominated the market from 2010 to 2022, the rise of new leadership. We've talked about it before, but I think it's good to review and review and review that message of what that new leadership is. Is it confirming in terms of the action in the market this month? And then lastly, waging war against the Central Bank of Japan. We think this is a big theme. They're the last central bank that's still doing QE out there. And we think that it's just a matter of if, not when, that ends, and how do we make money when it ends? So we're going to go through all of those points today. Now, what is the market trying to say here over the short term? So when we look at the S&P 500 and we sort of break apart all the stocks and sectors within the market itself, we're trying to look for symptoms. Is the market gravitating toward a more risk-on type of environment or risk-off? And kind of compare that to the headlines and the narratives that we read in the news and the media and everything else, right? And the media, of course, in the narratives is that recession, the world's going to end. Well, what's the market trying to tell us? So what we see here is that the S&P 500, and we look at the relative new high list, the worst performing sectors right now, in other words, the stocks that are making the least amount of relative new highs are consumer staples, utilities, and healthcare. What do those three sectors all have in common? Well, those are recession-proof sectors. So when we're entering into a slowdown or we're entering into a recession, where do investors pile into? They tend to pile into staples, utilities, and healthcare. Those are the sectors that performed the best last year. And it's funny enough, even though that recession fear is way up here, what are people doing? What are institutional money managers and hedge fund managers doing with their money? They're actually selling the stuff that worked last year. So what's making the relative strength highs? What part of the S&P 500 are making new relative highs? Well, first and foremost, materials. Right? Number two, consumer discretionary, then real estate and financials. What do all of these have in common? They're economically sensitive components of the stock market. But notice what's not in the top four: technology. Even though what's grabbed all the press over the last 2 weeks, ARK funds and Tesla and Lucid and all these other sort of sugar high types of growth stocks have been catching the headlines, the real moves have been happening in the quiet, more old economy sectors of the market where we are currently positioned, such as materials, such as industrial, such as real estate, such as consumer discretionary, right? So the market's buying the recovery. That internal strength is being led by those economically sensitive names. And a lot of this is being driven, of course, by the end of free money. When we think of 2010 to 2022, it was the era of quantitative easing. It was the era of free money, of low interest rates, 0% interest rates. That drives speculation. Hey, if you can just print off more money, why not make big bets? Why not roll the dice a little bit, right? Why? Because money's free. As that ends, you then have to take a more strict and more disciplined approach with your money. You have to say, I need a certain return on invested capital to justify the investment. And that's what the market is in the process of doing. We're ending that era of speculative free money and going into a more disciplined investment approach. So money supply down, cost of money up, that is driving more and more money into what we call this new regime. This new regime where valuation is king, old economy over the new economy, international over the US. Why? Because the US, as we mentioned last week, is dominated by technology. Technology and consumer make up over 50% of the S&P 500. Guess what markets are not dominated by technology? Europe, Japan, China to a certain degree. China's got a big tech sector, but most importantly, Europe and Japan, and the emerging markets. Those three markets have a very low tech weight. Not surprisingly, those markets are vastly outperforming the US over the last couple of months, and we expect that trend to continue. So what happens when money flows out of the US and back over to Europe and back over to Japan and back over to Brazil and other emerging markets? You are selling US dollars and you're buying your home currency as you repatriate your capital. That means US dollar goes down in value. Guess what goes up? The long forgotten and much hated and much maligned gold. And what benefits from gold? Gold mining stocks. So that shows you the whole ripple effect of how the end of quantitative easing impacts overall asset allocation. So what does regime look like when we post it in a chart or in a set of charts? This is Microsoft relative to the S&P 500. What we can see here is a broad top formation that is taking place. Microsoft's a great company, but it's expensive. It trades at 28 times earnings. It's got a $2 trillion market cap, what we call the bubble caps, right? Bigger than the size of Canada. So yes, it's a great company. No one's saying it's a bad company. It's just a really, really expensive stock for a company that's growing 15 to 20%. Meanwhile, we got this new vibrant regime, right? So Microsoft is part of that leadership of the sort of the old regime. This new, more vibrant regime is being led by companies such as, and not limited to, BHP, Rio Tinto, or if we look at the materials in general, the copper names, right? What we see is this chart goes all the way back to 1998 on a weekly basis. Look at this broad basing out and breakout of this stock, right? So this was the big commodities rally in the 2000s. This was the bear market, and now a breakout. And we think this is the breakout, very similar to this 2000 time period where we got the breakout after a 90s bear market on its way to a huge decade in the 2000s. We think something similar is setting up with the material stocks. We see the same thing happening with the steel stocks, right? Again, we take the steel stocks. This one's only going back a few years here, but we take this chart going all the way back to 2008 like we did last week. Steels are down over the last 12 years. More recently, a nice broad basing formation, breakout. The stocks are cheap. Steel prices are recovering. We have a lot of these stocks trading between 3 and 5 times earnings, and they're leveraged to a reindustrialization of the American heartland, the reshoring of American manufacturing activity. And just as importantly, no one's really that bullish, right? So if we look at all of these stocks, whether it's BHP, Rio Tinto, Glencore, Freeport, we look at Nucor, the amount of buy ratings on Wall Street is anywhere from 0%, if you're like Fortescue, to maybe 36% for Rio Tinto. To give you an idea, Amazon, for a big chunk of last year, had 100% buy ratings across the board. No one was bearish, even though you had many reasons to be bearish on Amazon and other FANG-related names. And then if we look at the steel index relative to the S&P 500, again, a multi-year relative strength breakout. Then we think of the fundamental setup for commodities. Just look at the charts and let the picture tell you what's happening out there. We have China that's reopening. This is the 1.4 billion person economy that has been basically in jail for the last 2 years, that are suddenly waking up, being released. And guess what? They consume a ton of copper. China consumes over 50% of annual production for copper in the world. On oil, they are the #1 oil consumer. What are inventories doing across both commodities? This is the 5-year copper inventory chart. Again, hitting near the lows, just as demand is starting to really ramp up and accelerate in China. In India, that's a big forgotten story here. From 2020 to 2030, we think India is a massive global driver of global growth. That's huge. We think India is where China was about 20 years ago, and we think they're going to drive copper demand. We look at crude inventory, so crude, gasoline, and distillate inventories, again, plummeting to 6-7 year lows. This is an important tell. And just as first week of February, guess what happens? A lot of Russian crude is going to start to face more price caps in Europe and further bans across the world. So we think that supply, we're in for a bit of a supply shock here on the commodity side. We want to make money off that. We talked about that war against Japan and QE. Real quick here, record bond buying here by the Bank of Japan, 18 trillion yen in terms of bonds that they're buying. And notice what's happening. So the black line here is inflation, and then the blue line is the blue line are interest rates in Japan. So inflation is accelerating, and so are interest rates. So at some point, something has to give. You can't just keep printing money as inflation is accelerating. So we're making the bet, the market's making the bet, that the Bank of Japan has to abandon QE. So how do you make money off this type of bet? You look at the banks. The banks and their earnings model have been suppressed for the better part of 30 years. Most of these banks trade anywhere from 2 to 4 or 5 times earnings at best, and they've literally done nothing for 30 years but lose money in terms of the stock price going down. And so we see here, this is a chart of the Topex Bank Index going all the way back to 1989. And you can see here, it's been nothing but losses. But notice what's happened here in the last 5 or 6 years, a basing and then a breakout. And then if we look at the shorter term chart, which is this chart here on the top right, this is the shorter term chart where we see this big, statistically significant breakout in the bank index in Japan. We, of course, have about a 10% weight in the opportunity strategy in Japanese banks. This is how we're making that play. So what's the bottom line here, ladies and gentlemen? We believe that old leadership is dying. We're going through regime change in the market. We want to be on the side of new leadership. The biggest mistake that growth managers and growth investors make is they try to pick the bottom on old leadership. Don't make that mistake, right? We think we're in year 1, year 2 of a multi-year run in new leadership being led by commodities, being led by old economy stalwarts such as the industrials, such as energy as well. So we think those are the 3 core areas: energy, materials, and industrials, and that's where that's where we're keeping our focus. So this high PE market bounce that we've seen here in terms of speculative growth stocks, try to fade that. We're not chasing that right now. We think it's best to use this time to build positions in those old economy areas of the market. And we do believe that the bill is coming for the Bank of Japan. That's what we got for you this week. Number is 888-543-3776. Please feel free to give us a call or reach out to your advisor if you have any questions. Other than that, have a great week, and we'll speak again in February. Talk to you soon.